Good afternoon. The theme I'm going to be exploring today is monetary policy divergence amongst the world's largest central banks. Specifically, I'll be looking at the Fed's reasonably hawkish stance, at least compared to the Bank of England's far more neutral policy approach. Ultimately, the question I'll be asking is whether the market is correct in pricing almost 3 Fed hikes between now and the end of next year, compared to less than a hike for the UK. The broad conclusion I reach is that, if anything, the market may be a little bit too dovish about the prospects for UK hikes, and ultimately we could see a bit of a repricing that could provide some support to sterling. But ultimately, I think markets are broadly fair in expecting the Federal Reserve to hike more than its cousin on the other side of the Atlantic. So first of all, the theme of monetary policy divergence, it's one that's been gaining increasing traction in recent weeks, and we're clearly seeing a broad spectrum. At the one hand, the Federal Reserve is expected to hike its policy rate finally on the 16th of December, and as I mentioned, the market is pricing in roughly 75 basis points of hikes over the next 12 months. At the other end of that policy spectrum, we have European central banks, which in 4 instances have negative policy rates. The European Central Bank is widely expected to announce a widening or extension of its QE program when it meets on Thursday. The Bank of Japan is under pressure to do more quantitative easing, and the central banks of Australia, India and China may well deliver further rate cuts to support economic growth. Somewhere in the middle is the Bank of England, which has oscillated between mild dovishness and mild hawkishness in the past 18 months. To put it in context, the market's really not pricing any rate hikes over the next few months, 4 basis points over the next 3 months to be precise. And even over a year, the market is only pricing 22 basis points. Put differently, that's roughly an 80% chance of a rate hike between now and the end of 2016. And that in itself is interesting, because if you take a sort of a bird's eye view of the US and US economies, what is interesting and noticeable is that on many metrics, the two economies look very similar. Their economies are growing at broadly the same rate, roughly 2.5% year to date. Their unemployment rates have converged to just above 5%. And if you look at headline CPI inflation, it's trending near zero. And that's what I've showed here in figure 2. On these 3 broad yet very important measures, the two economies look very similar. There's really not much to differentiate the two. Now, if we drill down to the inflation story, and that's obviously going to be critical for central banks, again, the conclusion we reach is that inflation rates in the UK and the US are broadly similar. Now, comparing headline UK and headline US inflation rates is a bit of a crude measure because of differences in what's included in these CPI baskets. So what's perhaps a more intelligent approach is to look at US market-based PCE prices versus UK CPI inflation. And that's what I've done here in chart 3. So if you look at the first set of blue and red bars, that's simply headline inflation. As I've said before, they look very similar over the past 12 months, but again, not perhaps the best comparison to make. The better comparison is the one that I've highlighted in dots, and that shows that the US market-based core PCE measure is actually very, very similar to the UK core CPI inflation measure. So when we compare apples with apples, there's really not much to distinguish US from UK inflation. Now, of course, that's consumer price inflation. It tends to not fully capture or not fully reflect asset price inflation, which is obviously a theme that has come up repeatedly this year. So what's happened to asset price inflation, specifically housing prices in these two economies? Well, the chart that I've depicted here shows that really in the past couple of years, we've seen US and UK house prices increasing at roughly the same rate, roughly sort of 4 or 5% per annum. But what does stand out is the fact that the slump in UK prices, house prices, was far more shallow after the great financial crisis than in the US, and the recovery was faster. So it leaves us in a situation where UK house prices are at all-time highs, roughly 4 or 5% above where they were in early 2007, whereas US house prices are still roughly 5% below their previous cycle high. So taking a further step back, if you look at the past decade, UK house prices have gone up by roughly a quarter in sterling terms. US house prices are only up by 10%. So we've looked at inflation. Let's look at labour markets, because clearly that's another important variable that the central banks will be looking at. And here again, as in the inflation picture, we're seeing some very clear similarities. In both the US and the UK, unemployment rates have been trending down at a very similar pace for the past 3-4 years. And in both economies, unemployment rates are currently just sitting above 5% of the labour force. In both countries, these are sort of 7-year lows. So as figure 5 shows, there's again not much daylight between the unemployment rate picture in the US and that in the UK. If we drill down further and look at what's actually been happening to earnings, the picture is somewhat more differentiated. What we've seen is UK earnings growth, this is workers' earnings growth, lagging that of the US for many years. That's the red line in figure 6. But recently, average weekly earnings growth in the UK has overtaken that of the US. So there's a bit of a catching up process going on. So if you look at it taking a step back, what we could argue is that ultimately we're seeing somewhat of a convergence in the growth rate of earnings in these two economies. Again, not a huge amount to differentiate the two. So when we look at these themes of inflation, asset price inflation, unemployment, worker earnings growth, the conclusion I come to is that the market is perhaps a little bit too dovish about the prospect for UK rate hikes over the next 12 months. I would argue that the market should perhaps be pricing in 1 or 2 hikes between now and the end of 2016 rather than an 80% probability of just 1 hike. But I would emphasize that I think the market is only slightly too dovish. I think we're talking about shades of grey here. Ultimately, if I'm correct in assuming that the market may slightly reprice the prospects for UK rate hikes in coming months, that could provide some support to the sterling dollar exchange rate, which is trading at the bottom end of a 12-month range of 147, 159. So we may see a little bit of upside in cable over the next 6 to 12 months. But overall, I think it's difficult to argue that the market is significantly mispricing the prospect for US and UK rate hikes. Put it differently, I think the market is broadly correct in assuming that we will see more Fed hikes than Bank of England hikes. And I highlight 6 reasons why it's reasonable to assume that whilst the Fed may hike 2, 3, 4 times, the Bank of England won't be matching the Fed step for step. And I'm quickly going to go through these six reasons. I'm sure that we could come up with further reasons But let me at least highlight the 6 themes which I think are important to policymakers. The first one is the starting point in the UK and US, and I'm going to state the obvious here, but the Bank of England's policy rate is already at 0.5%. Now, that doesn't seem like a lot, but in a world where many central banks have got rates at 0 or in negative territory, one could argue that having policy rates at 0.5% is a what I would call a hawkish, ultralight position. Importantly, the Bank of England, and this is something that Governor Carney has made very clear in his recent speeches and interviews, the Bank of England does have the room, if it required it, to cut policy rates by 25 basis points. This wasn't really an option available early in the year because of the financial damage it would have caused banks and building societies. But Governor Carney did make clear that today UK policy rates are not at the lower bound. There is theoretically room to cut rates should the need arise. Now, the fact that they could cut rates but are clearly not, and are clearly looking at potential hikes in the medium run, to me again reinforces this idea that the Bank of England is mildly hawkish, but only very mildly. Of course, the other side of the equation is that Fed rates are only at 12.5%. So the Fed's hike on the 16th of December, if it materializes, could effectively be seen as a catch-up hike between 2 economies that are somewhat converging. So I think the fact that we are at different starting points to some extent justifies that we may see faster, more pronounced hikes out of the US. The second reason I think the market's broadly right in its pricing is that whilst headline inflation measures and other measures of inflation look quite similar in the 2 economies, if we look at inflation expectations, they will potentially be more subdued in the UK than in the US. Precedent tells us that when CPI inflation is trending near 0, as it is in the UK, that tends to cap inflation expectations in the UK more than in the US, where consumers are not particularly focused on what is ultimately a volatile headline inflation number. So if this proves correct, if inflation expectations continue to be anchored in the UK, this is relevant because we know the Bank of England perhaps attaches more weight to inflation expectations than its counterpart in the US. Although one could argue that amongst the central banks, it's perhaps the European Central Bank that pays the most attention to inflation expectations. The third and important reason why I think the Fed feels potentially justified in hiking more than its British counterpart is the fact that up until recently, the US dollar was providing a very strong downward pull on inflation. To put it in context, in the past 18 months, the US dollar trade-weighted index, or nominal effective exchange rate, has appreciated roughly 20%. That's more than twice the appreciation we saw in the sterling nominal effective exchange rate. But what's interesting is if we look at the past 3 months, the US dollar nominal effective exchange rate is only up roughly 1%, which is not too dissimilar to sterling's performance, and we can see that in figure 7. The blue and red bars look very, very similar in the past 3 months, when clearly in the past they haven't. So in the case of the UK, sterling is not providing much inflation or disinflation, but what's perhaps more poignant is that in the US, the dollar, which had been acting as an anchor for inflation, is perhaps not going to be playing that anchoring role as much, unless, of course, the US dollar appreciation resumes in earnest. So again, this would perhaps suggest that the Fed is appropriately talking about Fed hikes, because it no longer has that currency anchor in play. There's a fourth reason why I think the market is correct and not expecting rapid UK rate hikes. Now, I mentioned a few slides ago the fact that UK house prices have surged in the past couple of years and have actually risen much faster in the past decade than in the US. Which ultimately begs the question then, well, perhaps the Bank of England should be hiking rates. At the end of the day, both the British Central Bank and government have acknowledged that a rapid rise in house prices does pose problems in terms of income inequality, affordability, etc. The problem is that history shows that rate hikes tend to be somewhat of a blunt instrument when used to cool property market. Furthermore, I suspect that the Bank of England is reluctant to unleash sustained rate hikes for fear of collapsing a property market and ultimately wiping out a large share of people's paper wealth. So what we've seen instead in the UK is policymakers trying, admittedly with varying degrees of success, to adopt what I would describe as a more surgical approach to controlling property prices. They've enacted policies to curb credit growth. They've enacted policies to reduce the attraction of buy-to-let, and they are trying, albeit with mixed success, to increase the supply of new housing. So bottom line is, yes, house price increases on paper seem to justify rate hikes, but I don't think the central bank will use this particular instrument to control the property market, particularly when you think that the 25% increase in property prices in the UK in the past decade masks a large number of intra-regional differences. So again, rate hikes are a blunt instrument and not one which I think the central bank will want to use in the UK. The fifth reason I think the market is broadly right in expecting perhaps a few more US rate hikes is that whilst unemployment has followed similar trends in the two economies, whilst wage growth has been outpacing US wage growth in recent months, what's interesting is if you look at retail sales growth, that continues to be stronger in the US. The chart I have here looks at retail sales in current prices as opposed to constant prices. So I'm looking at the current sterling and dollar value of retail sales. And whilst in both countries retail sales is growing, that growth rate is about twice as fast in the US than in the UK. And I think that is a variable that the central bank will be taking into account to the extent that faster retail sales growth translates into faster consumption growth, and this ultimately feeds through to inflation in the medium run. The sixth and final reason why I don't think we will see rapid rate hikes out of the UK is that monetary policy and interest rate policy needs to be considered in the broader context of all of the policies which are enacted, and that includes fiscal policy, credit policy, income policies, and others. So we cannot look at interest rate policy on its own. We need to look at it relative to what fiscal policy is doing. And what strikes me is that whilst in both the US and the UK we continue to see fiscal consolidation, i.e. a narrowing, a reduction in the fiscal deficit to GDP ratio, that reduction is more pronounced in the UK, and that's what I've tried to show in figure 9. Just to put some flesh on the bones, the UK government is aiming to cut its deficit to GDP ratio to 3.9% in the fiscal year ending April 2016, and that's down from nearly 5% in the fiscal year that ended April of this year. So that's a 1 percentage point planned reduction in the fiscal deficit. Now, by comparison, the US government is aiming to cut the US fiscal deficit by roughly 0.2 percentage points of GDP to 2.3% from 2.5%. Now, admittedly, the UK is starting from a far looser fiscal point, arguably, than its US counterpart. But the fact that the tightening is going to be quite rapid in the UK is something that the central bank will take into account. They will be cautious about adopting a hawkish policy stance at a time when the fiscal deficit is contracting and planned to contract further. That's not to say that if we see fiscal slippages, the central bank will feel more comfortable about perhaps hiking next year. But in the near term, certainly the central bank, and we know this, will and does take into account the planned fiscal path in the UK. And to the extent that fiscal policy is getting tighter and it will potentially be a drag on growth, the central bank will not want to compound that problem by hiking rates too aggressively. So again, in conclusion, I think that if we look at the numbers on the surface, one could make the case that the market should be pricing perhaps a little bit more hikes than they are currently in the case of the UK. I think that in the next few months we could perhaps see a slight repricing of the UK and US curves, and this in turn may provide some support to the sterling dollar exchange rate. But ultimately, I don't think the market is significantly wrong. I think there are, as I've highlighted, a number of reasons which justify the Fed and the Bank of England's relative positions, reasons which also, of course, support the market's relative pricing. Now, the final point I would make is this is a dynamic situation. Some out of consensus numbers, surprises, policy surprises could, of course, change the situation, and it's one which I will be reviewing regularly. But at this point in time, it doesn't strike me that there is a significant mispricing. Thank you very much for taking the time to listen to my presentation. I would, of course, be delighted to answer any questions that you may have or any comments that you would want to make. You can reach me on my email. And of course, my entire back catalogue of research is available on my website, www.olivierdesbarres.co.uk. Again, thank you very much.